a copy of the presentation prior to the webinar. If you did not, please type in your name and email address into the question box in the upper right section, and we'll shoot a copy of the presentation over to you. Should you have a question during the slide section, please type it in, again, using the webinar toolbar. The content portion of the webinar will take 35 to 40 minutes, at which point there will be ample time for questions. Joining me on the webinar is Doug Deitch. Doug's a principal here at Keystone, and I'll now turn things over to him.
Thanks, John. Welcome, everybody. And before we begin, I thought we'd play a little Back to the Future and touch on some of the headlines in our space a mere 10 years ago. In 2001, the insurance industry experienced its first ever net loss after taxes. Underwriting losses exceeded $53 billion, and the combined ratio for the industry topped 116%. Insurers at the time were complaining about the lack of investment income. The 10-year Treasury had fallen under 5%. Superior National, the largest work comp writer in California, was declared insolvent. And in 2002, the Kemper Cavalry was downgraded to a B+ and started hoofing down the path towards voluntary liquidation. Medical liability combined ratios exceeded 140%, forcing doctors to leave litigious jurisdictions or consider folding up their practice entirely. And the National Council of Insurance Agents reported casualty insurance premiums increasing between 20 and 50%. If we fast forward to 2012, we're all very familiar that the catastrophic losses have wreaked havoc with 2011 underwriting results. Industry folks are saying this is the worst underwriting loss since 2002. U.S. Treasuries are yielding just around 2%, so insurers are reinvesting at historically low rates. In April 29th of 2011, Majestic's parent corporation files for bankruptcy. And in California, January 1st, 2012, the workers' compensation pure premium rate increases topped 30%. Medical cost inflation and average cost of claims continue to erode insurance company results. So is the party over? No, not yet. There's still significant headwinds that are delaying universal change in this marketplace. A couple include the sluggish economy, along with larger carriers having the ability to release prior year reserves to stabilize earnings. However, as we can see from the headlines, the more things change, the more they remain the same. And it's this uncertainty with what your renewals will hold and the lack of control that insureds and brokers are feeling in this marketplace that is increasing their anxiety. So rarely has there been a better time to consider an alternative solution. And our goal as Keystone Risk Partners is to bring highly effective single-parent captive solutions to a wider audience of middle and upper middle market buyers who tend to receive limited or off-the-shelf products from traditional carriers. In the next 35 to 40 minutes, we've prepared a fairly high-level snapshot of who we are, what we do, and how our alternative insurance products can help you not only survive, but thrive in this changing marketplace. Who is Keystone? How can Keystone help? What can our alternative property and casualty products do? How do we get started? Well, hopefully, at the end of this webinar, you can comfortably answer these questions for your agency. For those of you not familiar with Keystone Risk Partners, we work exclusively with agents and brokers. We're looking for insureds that are willing to assume a portion of their own risk, and we're technicians with deep knowledge in risk management, banking, accounting, and taxation as it applies to the transaction of insurance. We're education focused. We spend considerable resources, time, effort, and energy visiting with agents and brokers and their clients and prospects to bring them up to speed on the value of these alternative products. That said, we are implementation driven. We've also spent considerable time building strategic carrier relationships and both onshore and offshore captive capabilities. In summary, we work as the back room for your agency to run the program in what we believe to be complementary roles. You are the insurance expert. We are the risk finance expert. My partners and I have been in the alternative space since the early 90s, and since that time we've established in excess of 300 individual and sponsored or rent-a-captive solutions. The takeaway from that is we know what works, and more importantly, we know what will not work. Through that time, we've been able to adapt to changing market conditions, using captives to develop easy and repeatable products for middle and upper middle market buyers. During the last hard market, we put together a number of different transactions and in excess of 90% of those are still with us today. In 2010, we launched Sunstone Assurance LLC, which is the latest innovation in the rent-a-captive space. More on that a little bit later in our presentation. But what I'd like to do is to take a few minutes in an effort to help bring into focus the characteristics of insureds that have enjoyed long-term success with our approach. We cater to a wide variety of exposures. Working with you, we analyze the insurance requirements and look to tie in unique attributes of the insured in order to unlock some hidden value in the way they finance insurance. Touching on a sampling of the deals we've done and highlighting some of those with unique characteristics, we put together a workers' compensation solution for a nursing home operator that not only was cost-effective, but gave them the ability to maximize their cost reimbursement formulas for Medicare and Medicaid. We worked with a manufacturer whose workers' comp, auto, and general liability captive program has been used to stabilize the cyclical nature of their business, funding the captive quite adequately during years when they are very profitable, and leaning on the captive during those tough years, having the captive actually pay for not only funding of claims, excess, as well as umbrella coverages, lowering the cash flow obligations of the insured for their insurance programs. We have a hospitality firm that used their workers' compensation program to create an insurance profit center for their management entity. We have a temp staffing firm that used their captive to develop a deductible reimbursement policy, provide a letter of credit very tax efficiently to their large deductible insurer. We have a nonprofit hospice that looked at long-term budget stability as their key goal, reinvesting annual proceeds from their program to lower the new dollars that come into their program for workers' compensation program purposes and using that for long-term stability. Excuse me. Solving insurance challenges with less focus on industry and class and more focus on some tangible attributes. The owner of the business, are they creative, an entrepreneurial thinker, willing to look beyond the insurance price to a more strategic purpose? Primary casualty premiums of $1 million or more, $20 million in gross revenue, pre-tax profits of $1 million or more. Historically profitable, large enough from a scale perspective to take risk, but these are all moving targets when we think about the size of an opportunity. Interested in or currently participating on a large deductible of $100,000 or more. Privately held companies, they have the ability to be very creative in financing their insurance and bringing value to their stakeholders. Insureds with unique ownership structures that typically don't fit very well with traditional underwriters and their credit evaluations. Those opportunities are right in our sweet spot. Substantial self-insured or underinsured in business risk. These are exposures in addition to primary casualty that can't be solved through traditional sources. So where do our products fit on the spectrum of insurance options available for your agency? One thing to note that regardless of what you structure for your insureds and what they buy, they will always pay for their own losses. So if we look at the left side of the spectrum, where we have guaranteed cost options, full risk transfer, the highest degree of volatility as markets change, the highest possible costs, profits retained by the carrier, little control for the insureds and yourselves, and really a lack of product differentiation. It's commodity. 100% of the buying decision tends to be focused on price. If we move to the right side of the spectrum, we have self-insurance, where there's limited or no risk transfer purchased, complete stability, lowest possible cost, and the greatest degree of control. In summary, the insured who self-insures their exposure owns the bank that finances their insurance obligations. So the more, as you move across the spectrum, the more risk you take as an insured, the greater degree of control you gain over financial decisions involving claims, and more importantly, a greater degree of control you have over the banking mechanism for financing insurance. So where is Keystone's expertise? We bring all of the benefits of self-insurance into a fully insured arrangement. So we mentioned fully insured, and I also mentioned earlier we have strategic carrier relationships. All of the Keystone products we have are supported by AM Best rated A or better carriers. So how do we create ready-made captive insurance products that have little or no competition from traditional sources? Really by creating a mold that can be customized, implemented, and serviced without significant lead time, considerable upfront expense, or expert resources at your agency or the insured level in order to evaluate. So what I'd like to do at this time is to turn it over to my partner, John Naughton, who's going to work us through the latest product innovations, features, and benefits.
Thanks, Doug. And before I walk through a sample product flow of fund structure, just a couple of comments about the captive structure that we use in the majority of our transactions. As Doug mentioned in our corporate bio, our roots historically have been traced to Bermuda, though we've gradually seen a flight onshore from both a tax and perception standpoint for many middle and upper middle market buyers. As such, roughly 4 years ago, we began in earnest a search for what we believed to be the best onshore domicile to capitalize and incorporate our own generically termed rent-a-captive structure. We invested significant due diligence effort and ultimately chose Delaware in October of 2010 to set up our new corporation called Sunstone. A little bit about Sunstone. Sunstone's a limited liability company licensed as a captive insurance company in the state of Delaware. Within Sunstone, each insured or each new insurance structure receives its own separate LLC or series business unit. The insured or captive structure controls the SBU and designates the ultimate owner or recipient of profit, and each individual SBU obtains its own tax ID number as a separate independent corporate entity. Individual SBUs inside of Sunstone that receive less than $1.2 million in annual captive funding may choose to take what's termed the 831B tax election. That tax election provides two unique benefits. Many of you on the webinar today have either heard the term 831B or have explored it to some extent. Later in the presentation, I'll spend a few minutes talking specifically about the 831B. Lastly, not all of our captive structures include Sunstone. We remain heavily involved with other onshore jurisdictions, Bermuda and Cayman as it respects offshore jurisdictions, and we do both rent-a-captives as well as single-parent captive structures. Some of the critical attributes of Sunstone. First and foremost, there is no risk sharing inside of Sunstone. This is not a group captive structure. Each SBU is legally separated from both the core as well as other individual SBUs inside of Sunstone. Ease of entry and exit. There's a pre-approved product structure with built-in runoff fees. Therefore, unlike single-parent captives or participants inside a group captive, the end of flowing premium into the captive isn't the beginning of lengthy, excessive runoff costs. Efficient annual expenses. Because the SBUs inside of the Sunstone structure share the overhead expenses, such as annual actuarial and financial reporting, there's a significantly lower annual expense load than what's found inside of single-parent captives. Investment flexibility. The ability for individual SBUs inside of Sunstone to tailor their own investment portfolio. A quarterly financial package that's provided to each individual SBU. And lastly, significant ownership flexibility in that each SBU's insured or customer can determine who actually owns underwriting profit and investment income inside of the SBU. So with that, let's take just a couple of minutes and talk about a basic captive structure that we utilize inside of Keystone for individual insureds. In subsequent webinars over the next several months, we'll be taking a deeper 201 dive into some of the specific applications. But for now, let's just take a couple of minutes and walk through a flow of funds on a traditional individual captive structure. And I'll use $1 million in traditional insurance premium for the example. I use that for a couple of reasons. One, ease of math as we walk through the example. Secondly, again, the structures that we tend to work with inside of Keystone are for individual insureds that are paying, on average, at least $1 million in standard premium annually. I mean, after all, for many of you on the phone, you have access or have seen group captives in the past. And an insured that pays less than $1 million in standard premium might be looking at a group captive as a home. Well, we have countless examples inside of Keystone where we've taken insureds out of group captives that were paying more than $1 million of premium and still sitting in a structure with other insureds that were paying significantly less. So for the majority of our structures, think $1 million in standard premium or higher. Well, in this example, traditional insurance premium for years was at, or in some cases, lower than expected loss. So why bear risk? But I'll use in this example a renewal at $1 million that is up from $700,000, $800,000, or $900,000 in expiring premium. With that $1 million that works its way through you as the broker into the traditional insurance company. In a traditional insurance relationship, obviously that insurance company is holding that entire $1 million, investing it, looking to generate an adequate investment yield while waiting to pay losses, and ultimately hoping to come up with a superior underwriting loss ratio. In a hardening or hard market where there may be redundancy in the rate, our structures look like this. That $1 million, once it gets to the insurance company, is segmented into a fixed expense component, in this example $350,000, and a loss fund or claims fund, in this example $650,000. $350,000 in expenses is the sunk costs, but $650,000 is now working its way into this newly created SBU inside of Sunstone. Well, we know that the carrier, in exchange for parting with that $650,000, is looking for collateral. In the majority of our structures, there is no separate incoming letter of credit from the insured, but rather the same dollars that are now sitting inside of Sunstone are used to provide an outgoing letter of credit utilizing an NAIC-approved bank by the insurance company to satisfy those collateral obligations. In addition, an escrow is set up with that insurance carrier, and on a monthly basis, the Sunstone SBU is reimbursing for paid claims. In our example here, ultimate paid losses being $500,000. Initial capital to set up the SBU is provided by the beneficiary, and ultimately that $150,000 in underwriting profit plus investment income is returned back to the beneficiary of choice. So why go through the brain damage? The shareholder here, whoever it is, just received $150,000 plus investment income that otherwise would have gone to the insurance carrier. And from a structural standpoint, just took greater control over their long-term cost of insurance. So who is the shareholder? Well, we have several examples of who actually owns the underwriting profit in our SBUs. Some of those include the shareholders of the named insured, family members of the business who set up the SBU structure, key employee retirement accounts, and not just owners, but we have examples where the safety consultant inside of an organization, the loss control provider or risk manager is now a recipient of profit in this newly created captive structure. Or an estate plan trust where wealth transfer begins to come into play. The key to these last couple is that how does a competing broker win on the spreadsheet against a grandchild's trust or some other wealth transfer mechanism that you've helped your customer set up? A simple financial illustration would show that on the left-hand side, under guaranteed cost structure, insurance premiums paid in are $1 million, fixed or sunk cost is $1 million, and therefore no potential for profit. Under the Sunstone alternative, we have $1 million being paid in, fixed expenses of $350,000, a 50% loss ratio, a modest $50,000 in investment income, and an estimated net savings of $200,000 or 20% of premium. 20% savings is significant. Put another way, if your client operates at a 5% margin, they would need to produce $4 million in new sales to achieve that same $200,000 in income before taxes. Only in the insurance business do we force our clients to think in 12-month increments. Well, what about the results of the structure over time? Simply looking at this program over 5 years yields $1 million in underwriting profit plus investment income. And the slide does not take into account the compounding of investment income on prior year underwriting profit. More to the point of a hardening market, a 50% loss ratio in a soft market now becomes a 30% loss ratio in a hard market. And again, guess who owns the profit? That trust or the key employee retirement account. In summary, the benefits of participation in the Sunstone Rent-A-Captive include fully insured plan. As Doug mentioned previously, the majority of our structures emanate with an A or higher rated insurance company. The ability for you to help your customer tailor an insurance structure where they only assume frequent predictable risk and transfer catastrophic losses to that A-rated insurance carrier. Long-term stability of premium and cash flow regardless of market conditions. Because in my earlier example, 65% of the premium had nothing to do with the traditional insurance market, we're to a certain extent insulating your customer from those market swings. Control through insurer's ability to have strategic input on premium, underwriting, investments, and risk. Reduction in cost through active participation in financial decisions involving claims. Access to insurance company profits, including underwriting profit and investment income. And then lastly, the elimination of letters of credit by creating a portable alternative collateral structure inside the captive. I used a guaranteed cost example earlier. Many of our structures include a large deductible front where all of the funding is being done directly with the captive. The ability for that captive to post a letter of credit back to the insurance company and remove the need for your customer to provide a letter of credit under a large deductible structure can be significant. So to finish off this section, let me go back and talk for just a moment about the 831B election. For those of you who have not worked with the 831B structure in the past, 831B refers to a section of the tax code which has been in place for several decades now and has two very significant financial benefits to it. Under the 831B election, a captive structure that writes up to but no more than $1.2 million in premium annually includes two significant benefits. The first is that any underwriting profit that inures inside of an 831B structure is not subject to taxation, which basically means that there is unlimited deferral of underwriting profit in the captive. Number two, once a distribution is taken from an 831B captive, the taxation on that profit is not ordinary income, but rather treated as a qualified dividend, currently subject to 15% tax. There are several enterprises that market solely 831Bs, or you may have heard them termed micro-captive or wealth captives. From a Keystone Risk Partners standpoint, we're extremely bullish on the 831B election when used properly. So this is how we use the 831B election. First, as an election when the casualty loss fund, or what's being funded into the captive structure under a large deductible or guaranteed cost with a retention structure, is less than $1.2 million. So you've got a workers' compensation large deductible scenario. The loss pick is less than $1.2 million. Why not check the box and elect to have that captive funded or taxed as an 831B? Number two, for an insured to fund directly into a captive, uninsured or underinsured real exposures. So the contractor with mold, construction defect, or pollution exposures, where there have been losses and they are currently uninsured or underinsured. The food manufacturer with a product contamination or product recall exposure, where there's been real losses paid in the past. So not fictitious exposures, but real exposures. And then lastly, for a combination of casualty exposures and uninsured, underinsured loss funding. So it's the contractor on a $250,000 deductible who has $500,000 a year in casualty expected losses and $500,000 a year in uninsured or underinsured losses. I'm going to turn things back over to Doug to finish up.
Thanks, John. And in summary, so we're dealing with a series of products where insureds take a portion of their own risk in order to gain control over the financial decisions involving claims and the direction of their premium contributions to fund the program. The goal is to significantly lower their net cost of insurance by keeping all of the underwriting profit and investment income that's generated by effectively owning the bank that finances their insurance, and use these profits in one of two distinct directions: to stabilize long-term premium cash flow by reinvesting profits and lowering the new dollars that come in, or to fund some estate or wealth transfer objectives, deferred compensation, through an accumulation strategy. Another important point is letters of credit, often a contentious bone between brokers, clients, and their carriers. By moving the collateral responsibilities from the working capital of the insured to the balance sheet of Sunstone, using that facility to provide collateral directly to insurers eliminates that challenge from your day-to-day headaches. So getting started with Keystone, why spend the time to focus on our solutions? Well, first off, we believe our products create differentiation. They're an additional arrow for your new business quiver and move you off the spreadsheet, but more importantly, shine a bright light on your agency's true value proposition, elevating your status as a trusted advisor. Keystone resources make these products easy to present, implement, and service. For those of you who worked with us in the past, we know that we carry the majority of the load. We ask you to help us simply in qualifying the opportunity and then supporting us through the process of education, structuring, and implementation. We will do the rest. Our products can boost revenue for your agency. We look at this in a couple of different ways. Our retention rate is incredibly high. The insured has a seat at the table in designing their program. This retention rate lowers the resources that are required by your agency to maintain this business, thus increasing its margins. But also, as you can see, there's a considerable opportunity for additional risk management services to be provided by your agency, which will also further boost the revenue. So we get the question quite often, how do you get paid? Well, the structures we put together are designed to be revenue neutral. You will continue to be paid as the insurance advisor, and mechanically we can either build the commission into the program or you can elect to run a fee outside. With the challenges that we've expressed already appearing in the marketplace, we would love for you to own the opportunity, own the idea with your particular client or prospect. So where can we help? Well, right away we have a series of products that are developed looking for new opportunities to structure for them. Sunstone Large Deductible Alternative. This is a comprehensive insurance program that we have that is designed to attract buyers that are currently, insurance buyers that are currently on guaranteed cost, some form of incurred retro, or a large deductible funded with cash. This is an ideal financial alternative for those particular customers. The Sunstone Direct Reimbursement Policy. Here we have insureds that are already on large deductible programs with carriers they're very comfortable with, or large self-insured retentions. We can issue a direct reimbursement policy in conjunction with that existing placement to be a more tax-efficient solution for not only funding claims today, but also creating a letter of credit alternative for using the captive to provide security to the carrier, freeing up the working capital of the insured within their current large deductible program. And oftentimes when we're presenting a captive insurance product involving Sunstone, the timing is not right for the full program to come together. The client often wants a little bit more information on the captive portion. Rather than let that opportunity pass by, we are able to issue a large deductible front policy with our carriers that is designed to transition naturally from a traditional large deductible towards a captive program down the road. Built-in arrangements with those carriers to transition security from a traditional portion to a captive portion. We also have unique opportunities that seem to have no traditional home. John mentioned the fact that we do a lot of manuscript policies for direct insurance that does not have a traditional solution, is either underinsured, uninsured, or self-insured. Things that keep your CFO up at night, but also keep you up at night, that don't have a solution. We have a vast library of direct policy forms that can handle just about any exposure you can come up with. And by using an 831B election, we're able to accumulate more rapidly assets within the captive available for that eventual loss or ultimate distribution to the plan beneficiary. So how best to partner with Keystone Risk? We mentioned this is a fairly high-level webinar. We can go deeper. We have webinars for agencies. We travel quite a bit. We can come by and go into some of the more detailed mechanics on case studies and direct applications to businesses that you see or that you currently provide services to. We can tailor a more specific presentation for you. If you have a customer that's interested or a prospect, let's set up a first step in qualifying that often involves a 101 call where we make the presentation through a webinar or through a direct visit covering all the basis of the alternative approach and how it may apply to that particular insured of yours. If there's still interest beyond that point, the next step is to dig into some numbers. Send us a preliminary submission. Treat us like an insurance market. We need essentially the same data as a traditional underwriter. 5 years of historical exposure, including losses, financial information to give us an idea of how that business makes money, and a corporate organizational chart, as well as any unique exposures that you would like this particular approach to address. So once we have that information, we can develop what we refer to as a spec house. It's an approximate view of how this alternative solution may work for your insured. We view ourselves as quite good estimators. Oftentimes our spec is within 5 to 7% of what the full-blown, fully underwritten traditional captive product with Keystone would look like. If there's interest beyond the spec house, we move into an implementation phase, building out the product, which involves an engagement of Keystone with your insured to implement the structure. And we do that in conjunction with your office, your agency, your back room as a vital partner in implementing and designing the plan. So when and who to call, many of you know one of us on the presentation today. We offer that there is no question that is too silly. If you have a baseline opportunity, give us a ring. Our interests are aligned. We're motivated to get deals done, so no question is too strange. We generally come up with a different way to approach your particular solution or particular opportunity, and chances are if we can't help you, we know who can and can refer you in that direction. So feel free to give us a call at any time to kick around an idea. We'll also mention that RIMS is in Philadelphia, which is our backyard. So if you're planning on coming in for RIMS, let us know. We'd be happy to set up some additional time to visit with you and or an insured that is coming with you to the annual RIMS Gala. So this concludes the presentation portion of our webinar, and we'd like to move to question and answer section. Two ways again to ask questions. Simply type them into the box or click on your hand icon and we will unmute your line so you can ask the question verbally.
First question, what would you consider a large deductible, 100K, 250K, higher, lower? $100,000 deductible for our traditional casualty structures is probably a pretty good benchmark. We do have structures that have a deductible that might be lower than that. In that instance, it really is all about the captive funding. What's the loss pick going to look like? We know that under the 831B election, we can fund up to $1.2 million a year, and our history has shown us that if the captive is not receiving at least $400,000 to $500,000 in expected loss premium from somewhere, that it begins to bump up against the fixed expenses. So I would use a roughly $100,000 casualty deductible as the minimum, but keep in mind that you can do a combination type structure where you're funding casualty expected losses plus uninsured / underinsured exposures.
Okay, what are some examples of your unique uninsured or underinsured policies? Well, as we mentioned, we've got a number of them. We look at wage and hour exposures. We look at litigation defense expenses for insureds that have heavy products liability that might have a pro rata sharing of allocated loss adjustment for any claim that may occur. Often find themselves defending the good name of their business and bearing 100% of those legal expenses on their own dime, looking for a way to tax efficiently fund for those obligations using some of our direct policy structures. John mentioned foodborne illness. We also have a number of different product liability offers, warranty exposures, things that make perfect sense for a business to offer their customers, yet oftentimes end up on their balance sheet as a liability, which is not necessarily a very effective way to finance those obligations.
Another question, what large deductible carriers do you work with? We work with several large deductible carriers. We work with them primarily in two ways. The first would be in instances where a business may not quite be ready for a captive structure, but they either are currently on or they're gravitating to a large deductible. And as Doug mentioned earlier, the majority of our structures emanate with an A-rated carrier. As such, over the years, we've developed a few what we would call unique carrier relationships, because everything is all about collateral in building our structures. Oftentimes we'll get involved in situations where our broker partner will say, I'm going to carrier X and Y, would you recommend another? And we may have one or two other carriers that we would recommend we'll take through the large deductible process to see whether or not they can compete with from a pricing and a collateral standpoint with your carrier partner. The other would be in our captives, either our Delaware SBU or our other captive structures sitting below large deductible carriers, and those carriers accepting security from the captive. We work with roughly a dozen different fronting carriers where our captives will issue, and those carriers will accept letters of credit from our captives. They're both bundled and unbundled carriers. They're household names. And so if you should get into an instance where you've already got a customer with a large deductible carrier but want to simply submarine our captive structure underneath it, for the most part, that carrier will most likely accept security from our captive.
Okay, couple questions that I'm going to bundle together. What happens in the first year if a new insured suffers $2 million in losses? And then do you offer retrospective type programs? A couple of things on the insured that starts out of the blocks with unfortunate experience. A couple things. First, in the case of the majority of our programs involving workers' comp, auto, general liability lines of coverage, any individual catastrophic event will be capped by the deductible or retention. So, and oftentimes losses would be limited for the captive at $100,000, $250,000, $500,000 per occurrence. And with multiple lines of coverage, we have the ability to bundle in what we refer to as a clash cover, where multiple lines, if there's a work comp auto loss together, that would count as one retention. So we think we've got the severity of poor experience well cared for. It's the frequency that becomes the challenge. So oftentimes an insured is coming out of a situation where they couldn't control their losses very effectively. Now they're in a position where they've got skin in the game and they're managing their claims very effectively, but their frequency is still there. The nice thing about the lines of coverage that we deal with, that frequent and predictable losses take some time to develop if they're not catastrophic. So we begin to see trends early on, and we mentioned a strategic plan. Oftentimes a carrier will react with price increases when losses are hotter than normal. Well, we have the ability to look beyond 1 year to 2 years to 3 years to 4 years and try and get that ship righted before those claims turn from incurreds into pays. So it's a real strategic play where the client understands how their experience drives their funding. If it's hotter than normal, they understand that they have to provide some additional funding for their obligations, and it's done over a series of years to fit in with their own strategic plan rather than be a reactive, urgent need to get things back online. So dialing into the question about retrospective, it's not designed to be factor-oriented. A lot of incurred retros or large deductible funded programs with LDF factors are really designed to swing back and forth premium obligations or funding obligations. We found that that model for the insurers that we're dealing with doesn't help the long-term stability that they're looking for in terms of the annual contributions. So we look at it a little differently. If there's the funding solution is built, most of our clients are looking to keep the underwriting profits in the program rather than have them forced out by distribution through a retrospective factor. So the goal by accumulating assets creates longer-term stability. So while it is loss sensitive, while clients have the ability to put more dollars into the program later on for claims experience, it's not regimented in a way that creates volatility and unpredictability. A number of clients that we get have come out of retros that said, boy, if I could have kept my premium in the carrier and had some financial incentive for doing that, I wouldn't have taken that incurred retro return. I would have let those dollars ride, knowing that things develop over time, and I'd be responsible for additional funding.
Another question. Explain how you take accounts out of group captives. I think this might be referring to the comment I made when we walked through the flow of funds at $1 million in premium. A number below that is right for a group captive, and we've graduated some folks out. That example, and we've had several of them, is just looking at traditional A Fund B Fund group captives that we're very bullish on, but looking at larger members inside of those groups that seem to get to a certain size where they're taking on a disproportionate amount of both the fixed expenses as well as the risk sharing. And in that instance, what we've used is really a structure designed around graduating from the group captive to your own individual structure, where you're still getting the benefits of captive risk financing, access to underwriting profit, access to investment income, the ability to incorporate some wealth transfer estate planning, but your insurance wrapper is tailored specifically for your business. So an insured that's paying $2 million in premium, they have access to large deductible carriers or retro carriers that can provide very competitive pricing based solely on that particular business's attributes. And in that instance, again, we've been able to take those businesses of size, probably using a premium threshold of $1.5 million in premium or higher, and graduating them out of a group captive into their own independent captive structure.
Another question, health insurance. Does health insurance fit into your captive products? Health insurance is an interesting model, getting a lot of attention nationally for captive approaches. We do not do health insurance through Keystone Risk Partners, but we do have a sister company, Pareto Captive Services, that does health insurance group captives for fully insured medical. So those insureds, 50 lives is probably the minimum. 100 to 200 lives is the sweet spot. These insureds are typically have options for simply fully insured medical. This group captive is an alternative solution for that particular buyer. If you have interest in learning more about the group captive for health insurance, send us your email. We'll be happy to forward it over to our colleagues at Pareto.
Well, there are no other questions. We thank you again for participating today. Many of our opportunities start with a simple phone call. So should you either have a question with something that we presented today, or want to walk through a captive opportunity, please give one of us a call. Again, thank you for your time, and we look forward to speaking with you soon.